I am Nick Cox, co-chair of the Committee on Lectures and member of World Affairs Series Planning Committee. It's my pleasure tonight to introduce our speaker. Will Martin is the World Bank's Research Manager for Rural Development. He has published extensively on such topics as the World Trade Organization and economic development, as well as agricultural trade reform. His recent work examines how such factors as changes in the prices of staple foods or improvements in agricultural technology can have an impact on poverty in low-income countries. Martin teaches frequently in World Bank training courses and is a manager of a number of large World Bank research projects. He obtained his master's and PhD degrees from Iowa State University, and it's a pleasure to welcome him back to his alma mater this evening. Before Will Martin gives his lecture, Peter Erasm would like to present him with an award on behalf of the Economics Department.
Well, Will, we're real pleased that you came back here, and we're going to present you with the Economics Department's Distinguished Service in the Public Interest Award. Thanks.
Thank you. Thanks very much, Peter, Ruth, and Nick, for that very, very lovely introduction and for this very, very generous recognition. It's wonderful to be back at Iowa State 30 years from the day I arrived here, almost to the day from the day I arrived here to begin my graduate studies in 1979. Thank you very much for coming to listen tonight and to talk tonight. I look forward to the opportunity of sharing some of the ideas that come from my work at the World Bank. What I'd like to do is to follow a roughly chronological organisation in my talk tonight. First, to talk about something of a golden age for agriculture that we've had over the last quarter century or so. Then to talk a little bit more about the rather troubled present and recent past, and then to look at the challenging future over challenges facing agriculture over the next 40-odd years to 2050. Now, in recent decades, we've had a lot of very helpful developments. We've had very high growth in agricultural productivity. We've had falling real prices for staple foods. Now, I know farmers don't see falling real prices for staple foods with the same positive enthusiasm that those of us concerned about poverty reduction do. But I'll explain. I promise I'll explain. We've had relatively low price volatility for staple foods over most of that period. And in developing countries, we've had a shift from taxation of developing country agriculture to a situation of relatively neutral price incentives for developing country farmers. Agricultural productivity growth has exceeded the rate of growth of productivity in manufactures, both in industrial and developing countries, over the period that Debashish Mitra and I analysed in a paper in Economic Development and Cultural Change, the period from 1967 to 1992. Now, many of my colleagues who haven't had the benefit of an education in agricultural economics at Iowa State find this a little hard to believe, that productivity growth in agriculture could be higher than productivity growth in industry, that general perception that agriculture is in some sense behind the dynamic sectors of the economy. But when you do the careful analysis, you look at the outputs, you look at the inputs, and you evaluate the change in the growth of outputs and inputs using a range of different techniques to make sure that you've correctly captured the phenomenon. What we found was that productivity growth over that period, the blue bar for agriculture on the right-hand side, was roughly twice as high on average as productivity growth in the typically regarded as more dynamic manufacturing sector. In developing countries, this margin of productivity growth was substantially higher. We see about 2.6% in developing countries for TFP growth in agriculture, about 0.9 in the manufacturing sector. In developed countries, the margin was somewhat smaller, but still really quite significant. Now, this actually, I think, reflects a huge amount of effort and resources that have been devoted to dealing with the classic public good problem of agricultural productivity. It doesn't pay an individual farmer to invest in research and development because the costs are all his or hers and the benefits are spread across all of the producers and consumers who benefit from that improvement in productivity. But underlying this was huge investments both by the private sector, think DeKalb and Pioneer, the hybrid varieties that had such a huge influence on the Midwest, on productivity in the Midwest, but also, especially for developing countries, the very, very major public role paid by public investments in research, development, and dissemination of innovations that contributed to the Green Revolution, which of course played a very big role in these productivity differences that we see for agriculture in developing countries. This is improvement in productivity is very, very important for two reasons. It directly raises the incomes of the farmers who benefit from productivity, and by contributing to lower food prices in real terms, it benefits the consumers, which is especially important when you consider that the poorest consumers spend 60 or 70% of their income on staple foods. What we see as a consequence of this is that world prices of food generally declined over the period from the beginning of 1983 to the end of around 2006. Now, this period corresponds pretty much to the period since I got my PhD at Iowa State, although, of course, I wouldn't attribute any causality. These prices over this period were actually, well, look quite volatile when you see them on the screen, but by historical standards, actually we had something of a great moderation in the price of agricultural, price volatility of agricultural prices. We saw a great deal more price volatility in the 1970s and, of course, in 2008 in very recent memory. But very importantly, over this period, you had this steady and quite strong downtrend in the real prices of food. So here's agriculture contributing through productivity, agricultural productivity, contributing to the incomes of farmers through higher productivity at any given price, and contributing to the welfare of consumers, and especially poor consumers, by lowering the prices that they face for the staple foods on which they depend so heavily. Another important development over this period has been a very, very marked change in the incentives faced by farmers in developing countries. A very influential World Bank study conducted by Anne Kruger, Maurice Schiff, and Alberto Valdez, a Kruger-Schiff-Valdez study in the late 1980s, highlighted something very important about agricultural incentives in developing countries, and that was a very, very strong phenomenon of urban bias, that typically producers were taxed both directly and indirectly in order to try to lower the price of food in developing countries. Now, while lowering the price of food in developing countries can help lower poverty, the sorts of policies that were frequently used, policies like export restrictions on staple commodities, products like cotton, cocoa, coffee, widely used in Africa to lower the price to producers in order to generate government revenues. These are very, very problematic policies from the point of view of poverty reduction. And one of the major changes that we saw after the 1980s was the reduction in the taxation on agriculture. This is the nominal rate of assistance. If it's negative, that means agriculture is being taxed, as it was pretty much throughout this period up to 1994. If it's positive, it means the sector is being protected. Well, what we had after, and this is almost causal, I suspect that the authors of the Kruger-Schiff-Valdez study might see it as such. What we had after that study was released in 1988 was quite rapidly an improvement in the incentive situation for agriculture in developing countries, reduction in the taxation of agriculture in developing countries. So over the whole period we see something of a trend away from the taxation of agriculture in poor countries. In fact, a movement to non-trivial levels of protection of agriculture in developing countries. But the situation looks quite different if you break up the set of commodities. And here in these two graphs I'm drawing on a study of 90 countries led by Kim Anderson when he was at the World Bank and which I've had the pleasure to supervise over the last couple of years. Here we have very different incentive situation for exportable commodities and for importable commodities. If you look at the export graph here, the orange line, there was a situation of very, very strong taxation of exportable commodities through export restrictions that lower the domestic price, export taxes, and other measures. And then more recently, the really big change we saw in the other graph has come about by reduction in those export barriers and restrictions. Part of this was brought about through policies where through engagement with the World Bank and the International Monetary Fund, reductions in the taxation of some of these export commodities. But I think a lot of the change was due to the recognition of the incentive environment that was being faced. We have considerable amounts of protection now on many import competing commodities. And that, I think, is something we've noticed in the Doha negotiations, the concern, the desire of policymakers to retain the flexibility to have protection on import competing commodities is one of the issues that went to the heart of the breakdown in the negotiations on the Doha agenda last year in Geneva. Okay, so through this period, as I mentioned, through this golden age, we've seen some very, very promising and healthy developments in agriculture. But the last year or two, we've seen a very, very troubled period. Why is it that things have deteriorated so much and so obviously, that resulted in what was it that contributed to the big increase in prices, the commodity price surge or boom, depending on your point of view, of 2008. Now, part of it was that we've had, throughout this period, substantial underinvestment in agricultural research and development. Another phenomenon has been declining international support to agriculture. Partly as a result of these, we've seen declining growth in agricultural productivity, and then at the same time we've seen new demands on agriculture, especially the demand for biofuels, which contributes so much of an increase, a large amount of the increase in demand for grains and other biofuel imports. Now, what do I mean by underinvestment in agricultural research and development? Here I'm drawing on some estimates of the rates of return to investments in research and development, agricultural research and development, prepared by Julian Alston and Phil Pardee, work that is based on hundreds of studies undertaken at Iowa State and other universities to look at the rates of return on public investments in research and development. And what these studies find is that the average rate of return on investments in research and development has been absolutely enormous. On average, it's close to 50% per year. You invest $1 in agricultural research and development in an efficient organisation like the Agricultural Experiment Station at Iowa State, and the rate of return, even after allowing for the long lags, often long lags between investments in agricultural research and the payoff from that agricultural research, is something like 50 cents per year. Now, people generally think they're doing quite well if they get a rate of return on average of 5 or 6% from investments, a real rate of return of 5 or 6% from investments in the stock market over a long period. A rate of return of 50% to close to 50% is absolutely a staggering rate of return. If you ask it slightly differently, if you have a discount rate of, say, 5%, how much is this? How much is it that you get per dollar that you invest in such a long-lived investment as agricultural research and development? Then it's about $10 you get back for every dollar that you invest. Now, that kind of benefit-cost ratio is fantastic. It really tells you that it would be a good idea to invest more in this activity. Unfortunately, that's not the way the world works. Investments in public research and development need to be organised, the funds need to be raised, they need to be allocated, and it's difficult to get enough resources in there to push these rates of return down. What economists actually would like to see is these rates of return pushed down to 5 or 6 or 7% for comparability with rates of return on other investments. So here we have a very classic case of underinvestment in agricultural research and development. And it's not only agricultural research and development where governments tend to underinvest in public goods. It's in areas like rural infrastructure, rural health, rural education, areas where there's a strong public good dimension and very, very high rates of return, not only in terms of the economic benefit, the aggregate economic benefit, but in terms of improving the opportunities for poor people in rural areas where most of the world's population of poor people live. One thing I should mention before moving from this graph is that these rates of return are very high just about everywhere. The global average is something like 47%. It's higher, appears to be higher in Asia, Latin America, and still very, very high in sub-Saharan Africa, despite all of the problems there and the difficulties in infrastructure and so on, but also the difficulties in getting a really high and obvious green revolution to take root. And some of my colleagues at World Bank are working on this issue right at the moment. Why is it that it's proven so difficult to successfully replicate the green revolution that had such beneficial impacts on Africa? Unfortunately, not only has the rate of investment in public research and development been too low, it's actually, and here I'm sure to the chagrin of many people in this room, it's actually been falling in the developed countries. The growth of investment in R&D has actually been negative, was negative rather, in the decade to 2000, for which is the latest period for which data were available. In developing countries, agricultural research and investment has been, in agricultural research and development has been growing, but most of that is driven by a few countries, particularly China, where investments in agricultural R&D have been growing very, very rapidly. Those growth rates have been much lower in other regions. Support from the international donor community to agriculture has unfortunately been declining until very recently. If you look at the percentage of the poor in developing countries that live in rural areas, the orange line there, you see that it was roughly 90% of the poorest people in the world back in 1990 lived in rural areas. That's been falling. You hear a lot of discussion of the fact that poverty is increasingly acquiring an urban dimension as the urban areas, as urban populations expand. But it's still the case that roughly 75% of the poorest people in the world live in rural areas. And back in the 1990s, after a lot of investment in agriculture from the donor community, here we're looking on the right scale, something like 12% of that investment went into agriculture, has been falling very steadily to around 4% of total overseas development assistance. So this support, which part of which goes to research and development, but part goes to infrastructure and other investments, finance, helping to promote the development of financial markets in general, all of these investments has actually been falling very, very dramatically. In recent times, there's been a recognition that this is a real problem. The World Bank and other donors are substantially increasing their assistance to agriculture after recognising the scope of the problem, and particularly after the real wake-up call administered by the dramatic increase in prices of staple foods in 2008. Another thing that's been happening is within the research and development spending, there's been an increase in emphasis on food quality and environmental impacts in developing country, agricultural research and development, with a reduction in the focus on increasing yields. Now, increasing attention to environmental and food quality impacts is hugely important, but resources have to be allocated, and one side effect of this has been a reduced ability to transfer yield-enhancing technology to developing countries. A lot of the very rapid progress achieved in the Green Revolution was by being able to look at wheat or rice or maize, improvements in varieties developed in labs like those at Iowa State, and to take those, to adapt those to the needs of developing countries. I think in the international system, the consultative group on international agricultural research, there as well, there's been somewhat less focus on yield-enhancing externalities in the international research system, and more of a focus on country-driven research. So rather than thinking about what's the best way to get an improved variety which will benefit lots and lots of people in lots and lots of countries, there's been more of a focus on what's the best for a specific country, and therefore less attention given to where the spillovers will be, where the greatest benefit will be worldwide. One consequence of this, of all of the developments that I've mentioned, is that yield growth in developing countries has declined. If you look back in the 60s and through the early 1980s, yield growth for the key agricultural staples, maize, rice and wheat, was in the order of 3% per year. I mean, these are really, really rapid rates of growth that changed the world very rapidly, and now have fallen to about a half of that in recent years. So this assumption that rates of productivity growth and rates of yield would go on rising while the inputs, the preconditions for this were declining, has contributed to the problems that we've seen. So the slowing yield growth and rising demand, increasing demand for food, and the new demands coming from biofuels contributed to a gradual rundown in world grain stocks, and one that initially didn't seem to do a lot of damage, but which ultimately contributed to the higher price volatility for staple foods we're seeing now, and to the food price crisis we saw in 2008. But the combination of lower productivity growth and continuing demand seems likely to hold prices above past levels. At least that's our current assessment. just to look at the graph, if you look at grain stocks since 2000, what you see is that grain stocks around 2000 were about 30%. This is the stocks to use ratio, the ending stocks at a year, how much is available at the end of the year that could be consumed this year, or it could be carried into next year, or at least it's a decision about how much is available to be carried into next year, was around over 30% in 2000, but has declined to something like 15%. And one of the things that happens when stocks get very low is that prices can become very volatile. You can get the sorts of short-lived booms in price that we saw in 2008. The market becomes very unstable. If you have a slight reduction in the supply because of some sort of reduction in the harvest or some sort of unexpected increase in demand, the stocks are not available to bring forward consumption, and so consumption must adjust. And adjusting consumption of staple foods is very hard because these commodities, it takes a very large change in price to reduce consumption to match the available supply. So what we've seen is a big increase in price volatility in recent years, a dramatic price spike for all of the grain commodities, but especially for rice. A huge increase in the price of rice in 2008. A terribly troubling increase from the point of view of poverty. And that raised a really important question last year as we started to deal with this. Those of us working on research related to agriculture and agricultural trade was, what were the consequences of this? Did the food price rise increase poverty? It's a very difficult question to answer. In fact, you can't answer it without looking at the data. There's only an empirical answer will get you anywhere at all. We know that the poor spend most of their income on food. But at the same time, we know that most poor people live in rural areas, and most of those, or many, a very large number of those, earn their income from agriculture. So it could be that high prices will redistribute income to the poor, and that maybe poverty will be lower with higher food prices. Certainly if you have higher food prices in Iowa or in my home country, Australia, farmers' incomes definitely go up. Farmers are better off. So it's possible, given that people in rural areas, farmers are typically much poorer in developing countries, it's possible that these high food prices would be beneficial, would lower the number of people in poverty. But to know the answer, we have to examine the impacts on households. Because in developing countries, the link between food prices and the welfare of farmers is quite a bit different from the situation in the industrial countries. Industrial country farmers tend to be very specialised in the production of agriculture, often in just a few commodities. Developing country farmers often try to diversify their small portfolio of resources. They'll put some of their resources into staple crops, some into vegetables, some into cash crops, and they're very frequently buyers of staple foods. So it's very likely that farmers in poor countries, even farmers in poor countries, will actually be made worse off by an increase in the price of staple foods. So to know what the impact was of this surge in food prices, what we had to do was to examine the impacts on households. And there we drew on the large number of surveys of households in developing countries conducted by the World Bank. We looked at where farmers got their income, where households got their income from, and where they spent their income, to try to work out the balance between the benefits of higher incomes from sales of food and the costs associated with higher prices of food to consumers. Then we worked out for each household the impact on household welfare and calculated changes in poverty rates. We focused, in this work, Mara Savanek and I, focused on food price changes between 2005 and the first quarter of 2008. That's prices in a level comparable to those today, not the sort of the very peak prices that we saw in the middle of 2008. And we projected, using the changes in prices and the patterns of income and expenditure of households, what the impact would be on poverty in poor countries. And what we found, the very, very rough back of the envelope estimate, was that about 100 million people had been pushed below the poverty line by the short-run impact of that increase in prices. So it's something to be very, very troubled about in our troubled present, and the price volatility, the consequences of this price volatility for poor people. When we look at cases of individual countries, you get a very, very diverse sort of a pattern here. In some countries, like Nicaragua, Pakistan, the impacts on poverty were very, very large. In these countries, you have lots and lots of households that are net buyers of food, even rural households, and who are hurt very badly by increases in prices of commodities like wheat and rice. The blue bars are the rural, the red bars, the urban, and the orange bars, the total impacts. So typically what you see, say with the Nicaragua case, is that poverty rose more in urban areas, but that it rose rather than fell when prices went up, when agricultural prices went up, even in rural areas, the blue bar. And the overall impact on poverty was somewhere in between. Now, as always, you find quite a lot of exceptions, but they tend to be somewhat smaller. In Vietnam, rural poverty fell when prices went up. Higher prices of rice are helpful to many households in Vietnam who are net sellers of rice. Small farmers who are sellers of rice, who depend on sales of rice for a good part of their income. In all of this work, we looked at the impact of commodity prices, we looked at the impacts of these changes in commodity prices on wage rates, took those factors into account, and we did a lot of robustness checks to make sure that we weren't overlooking or ignoring something important. The average impact, though, across all these countries was for poverty to rise more in urban areas than in rural, but to rise quite substantially. So a very worrying impact when we have this sort of volatility, especially these short-lived surges in prices of staple foods. Now, the recent crisis, I think, has influenced thinking a great deal. It's raised concerns amongst many policymakers about the reliability of food markets. Many policymakers, I think, now are much more focused on increasing self-sufficiency in agriculture in developing countries. Many policymakers feel that the actions that they and others took to try to insulate themselves against changes in world market prices were an important aspect of their response to that. And that's something that we took into account, that policymakers typically try to resist because of these important poverty impacts and redistribution impacts. They try to resist the impact of big increases in world prices, and that's something we factored in. But one of the things that we have a collective action problem, a classic collective action problem here, is that if all countries try to insulate their markets from a change, let's say all exporters put on export restrictions the way many did, and all importers try to lower their import duties to bring down the price, then the consequence of that is to make the world price rise even more. And that was an important feature of the food crisis last year. As soon as a major country like Vietnam or India in the market for rice put on an export restriction, that helped to hold down their price somewhat, but the world price rose. And that weakened the impact both for them and made the imposition, the impact of the higher food price worse for other countries. I think a lot of important lessons were learned last year, though. It really did help to identify ways to help manage price spikes. Emergency food aid turned out to be really important. The World Food Programme found itself absolutely strapped. It had basically budgets contributed by donors. The price had gone up. It had less food available. It could buy less food, and the demand, the need from poor people to do something to deal with, to ensure availability of food, had gone up dramatically. And I think the countries, industrial countries, were actually very, very quick to respond. I think Robert Zoellick at World Bank was very, very quick to emphasize the importance of this issue and to contribute to the sense of urgency. And I think donor countries were very, very good at responding to that. I think another lesson was that safety nets are really important, social welfare programs that can deal with this sort of shock, because it's likely we'll have more of these sorts of shocks potentially associated with rising prices as we come out of the recession and so on. Safety nets, it's important to have safety nets there. It's important to ensure farmers have access to inputs. A lot of farmers in Africa had terrible difficulty getting access to fertilizer, for instance. So even though prices were going up, farmers were unable to respond to that. I think one thing that will come out, there's a very active discussion underway about trying to stabilise prices to deal with this sort of crisis. I think one thing that the conclusion of that is likely to be that this is actually very, very difficult. We tried to do this in the 1970s. It didn't work then. It's probably unlikely. I think it's going to be very, very important to focus on dealing with the problems of poor people rather than trying to stabilise world prices. But long-term high prices are a concern as well for poor consumers, and that brings me to the final section of my talk. Even though producers can adapt to take advantage of high prices, consumers, the impact on consumers is so strongly adverse on poor consumers that it's very, very difficult for them to adjust. And productivity growth is key in the longer term, because productivity growth can maintain returns to farmers or raise return to farmers and lower costs to consumers. So moving to my third topic, the challenging future to 2050, what we know, or at least our estimates, our best guess is that food production is going to need to rise by something like 50% between now and 2050. Population's growing, there are increasing incomes in some poor countries where demand for food is still responsive to incomes, much more so than it is in the industrial countries, and there are new sources of demand like biofuels. There's very little new land that can be brought into production, and the adverse environmental consequences of the sorts of land clearing the industrial countries did long ago so horrendous we're unlikely to see that. Most of the increase in production has got to come through increases in yields. Now, how could this be achieved? There are really two alternatives. One is through price incentives. You pay higher prices. Any Iowa farmer can tell you the consequence will be higher production. And some interested parties, the Minister for Agriculture in France has made this point, protection's a good thing, it raises output. But productivity growth, I think, realistically is the only way to get these sorts of yield increases. Pricing incentives, they're frequently politically attractive, especially given the concerns that have been heightened about food security. We've seen a willingness to move towards providing support to agriculture, price support to agriculture in developing countries. But realistically, what we've got to remember is that agricultural price incentives are provided typically through import protection. Developing countries typically don't have the fiscal space to provide large-scale subsidies. And once we take that into account, we've got to recognise it's very, very hard. This is no coherent way to increase global agricultural output. Import protection for foods, a subsidy on production in that country, but a tax on consumption, and it also makes the pattern of world food production inefficient. It moves the production to countries that are less efficient in producing food, the importing countries, away from the more efficient parts of producers in other parts of the world. And then we run into the problem that if we raise food prices through protection. The poor are spending large shares of their income on food, and many farmers in poor countries are typically net food buyers. So we face this constraint that we could increase poverty substantially. And just to look at a graph, this importance of food, Uganda, a low-income country, I understand a number of people in this room have recently been in Uganda on development work. But the poorest people, the poorest decile, spend about over 60% of their food. Within that group, the really poorest people are spending much higher shares of their income on food. Just that dependence on food prices is so important. If we try, though, for instance, if we try to raise agricultural output by 1% using a policy of protection, here we've used a model of the world economy, raise world output of food by 1%. What do you have to do? How much protection do you need to give? Well, the answer, if you focus on developed countries, you have to increase protection by 22%. That's more than a doubling of the average protection provided in the industrial countries. If you try to do it by raising protection in developing countries, you have to push it up by 40%. And you ask, what's the purpose of this? When you move to the two lines below the red line, what's happening to global food consumption? Global food consumption goes down. Total agricultural output goes up, but agricultural output is an input into food production sectors. You've raised the cost of food to those sectors. Consumers pay higher prices. Consumer consumption actually falls. If we use the standard methods of economic analysis and look at the consequences of this for welfare, we find there are large adverse consequences in terms of economic welfare. If we look at the impacts on food prices, if you put increases in protection in developing countries, the right-hand set of columns, food prices go up by an amount that depends on how important food imports are in that country. If it happens in developed countries, food prices in developing countries go down because world market prices decline as a consequence of that protection, and food prices in developing countries then fall as a result of that. The impacts on poverty, if you use protection in developing countries, you get some very substantial increases in poverty rates in developing countries. Depends on the situation. They're small in some countries like Vietnam, but very large in other countries. I mean, protection as a means of raising food output, agricultural output is not very successful in achieving its goal, or almost totally ineffective, in fact, will lower food consumption, increase agricultural output, but it will certainly raise poverty if developing countries move to a higher protection regime in order to raise agricultural output in some sectors. What about if we use a focus on productivity? If we do that, an increase in agricultural output of 1%, we consider global agricultural productivity or developing country agricultural productivity. In that case, the agricultural prices decline, food consumption goes up, there are substantial welfare gains to developing countries. And productivity is something that can be replicated. You can go on increasing productivity. You want 1% increase in world output. You can you do that and then build on the increased yields from there, as has been done so successfully in US agriculture. Impacts on food prices. Productivity lowers food prices, raises food consumption in the poor countries where we've analysed the consequences, and the poverty impacts are extremely favourable. This is just for a 1% increase in world food, in world agricultural output, and you see these very substantial reductions in poverty, especially if the productivity growth is focused in developing countries, for which we have mechanisms like the Consultative Group on International Agricultural Research to help promote that. Madam Chair, I've reached the end of my conclusions. What I would like to do, just to summarise, I guess, our golden age of high agricultural productivity growth may be coming to an end. Certainly the benefits, the rate of agricultural productivity growth seems to be declining, have been declining, and unless more resources are invested in agricultural research and development, we're likely to see some quite serious problems in terms of rising food prices, even without protection policies, and even worse if we do see increases in protection. Agricultural research and development is going to be important to continue to allocate a lot of those resources to raising the output of staple foods that are so important for poor countries. Agricultural protection, many interested parties will argue for it, but it's important to remember that it can't raise agricultural output significantly because so much of it is going to focus on import protection, going to make agricultural production inefficient, raise the price of food and reduce consumption. And there are substantial risks, especially if developing countries use agricultural protection, of raising poverty rates in developing countries. A key challenge is to invest in raising agricultural productivity in poor countries. Thank you.
We have about 10 or 15 minutes for questions. If you want to give questions, we have a microphone over here, and if you would just line up, please try to keep your questions brief, and I'll take the privilege of the first question, if I may. What is the risk of a sudden surge in agricultural prices in the future as the world economy begins to come out of recession, and how much of the price spike was due to problems with yields, problems with biofuels, or problems with input prices, or was something else going on?
Oh. Yeah, thanks, Peter, for that first question. A lot of this is kind of unknowable, of course.
No one can prove you wrong.
That's right. Thank you. But I learned macroeconomics from Dennis Starleaf, so I guess there are some useful structured things that you can say about it. I actually think one thing that's really quite worrying is that coming out of the major financial crisis that we've experienced, there's a significant risk of overshoot. Monetary authorities in many countries have pressed the pedal to the metal very hard in terms of monetary stimulus, and I think history suggests that it's pretty hard to take that off in a smooth and continuous way. There's some risk then that we'll see an increase in inflation, and Dennis can correct me if I'm wrong, and if we do see that, one of the things that tends to happen is a boom in the prices of land and gold and commodities as people worry about the declining interest rate on bonds, on the alternative forms of investment, bonds and stocks. So we could see some increases in inflation. The decomposition of the food price crisis, the food price increase into various sources is extremely difficult. One of my colleagues famously argued that biofuels was a very, very large share of that. And in doing that, he looked at the increases in demand. It wasn't and the increases in supply over that period from 2000, and found that the biggest change was in the biofuels rather than the seasonal increases or the increases in consumption demand in developing countries that many other people had identified. I think what you've got to be really careful of in doing that decomposition is that after prices started to spike, many countries intervened on the trade policy side. So you had these export restrictions to try to avoid prices in exporting countries going up. You had dramatic reductions in import barriers in many other countries that typically try to keep prices a bit above the world price. They tried to buffer themselves to insulate by lowering that price. And each time that happened, the world price went higher. So if you ask what are the causes of this, there's a question then about whether that's a shock or whether that's a response. If you leave that as a separate shock, I would say the trade policy changes were actually a very major influence on that. As well as that, you had all sorts of panic in the market for, especially for rice, as people worried about whether they could get access to supplies. Ah, great question. Yeah. Well, I mean, the fact that so many prices went up at once, suggests there's some sort of common factors going on there. But I do think that this, the stocks story is really, really important. When you have lots of stocks and you get a shock, it's relatively easy to take some of those stocks and consume them now. Just a smallish increase in price provides an incentive to increase, to reduce stock holding at the end of the year. When you get stocks down to 15%, a lot of those stocks are not accessible. They're working stocks. They're product in the process. And they just can't be accessed, so you can't reduce stocks in order to buffer the impact. There's certainly a lot of corn in the Midwest, but it's a very big world out there. So this stocks, the low stocks ratio really tells you a lot. The most sort of, I think, intellectually satisfying model of world of markets for storable commodities suggests, and this is the work of Deaton and LaRocque and others, that grain prices or prices of storable commodities will spend most of their time in the doldrums, punctuated by short-lived booms. And that's the sort of thing we saw recently. The worrying thing, I think, is the prospect that we may see high prices over a sustained period. That really worries me. If productivity growth continues to decline and there isn't land available to be brought in to increase the supply.
Question. Going back to the slide when you talked about urban development and rural development, in developing countries there's always a tension between the two.
This slide?
No, where you compare the countries.
Yeah, the poverty impacts, yeah, sure.
Yeah. Between rural and urban.
Yeah.
There's always a tension between the two as developing countries are starting to increase their urban development. How should a country keep a balance between the two?
Right. Yeah. Thanks very much for that question. I think there are some really good win-win solutions. If you start off with a really poor country and 70 or 80% of the population's in agriculture, that country gets to, as it gets to high income status, it's going to get down to just a few percent. Mm-hmm. The people who are going to be the urban people were originally the agricultural people. Yeah. So you really want to think about how you can facilitate that transfer. Right? Yeah. We used to talk a lot about the farm problem, where incomes in the industrial countries in agriculture used to be way below the incomes in the urban sector. That's changed in the United States and some other countries. But that dynamic, that problem, that cost of adjusting out of agriculture and moving into the urban sector, that cause that income gap. The same problem arises in developing countries. So what can you do, what best do to help? One important set of things is to try to lower the cost of moving out of agriculture. If you have great schools like Iowa State available to the country mice, then they'll be able to get a good education and move to alternative occupations. If kids don't have that, you get this in rural areas, you get this enormous waste of talent.
Right.
So that I think is an important thing. That really helps to lower the costs of adjustment. Do whatever you can to lower those costs of adjustment. Improving transport can be very, very helpful. The northeast of Thailand, all the roads up there helped poor people move out of there. So improvement, those things that lower the cost of adjustment out of agriculture. Another thing is really helpful, can help the people who remain in agriculture, is improvements in technology that are available, productivity that are available to all producers, especially the smaller ones. That can do a lot for their income. If a farmer's producing $100 worth of output and only selling 10 of it, then a rise in price is not helpful to that small farmer. A rise in productivity gives that farmer a lot more benefit. So that's some of the key things that you can do, and that don't really increase the tension between urban and rural, that help both sides.
Okay.
Hi, my name's Sam Bird. I'm a sophomore in College of Agriculture. I have a question about your slide on the rate of return from agricultural investment. Because with your presentation, it seems obvious that countries should invest, so I want to get at why they aren't. In what areas is it most beneficial to countries, or what areas are profiting most from this investment in research? Is it more of commercial farmers or small-scale farmers?
Yeah, these are based on hundreds of studies. It's a meta-analysis based on hundreds of studies of different particular cases. These are an average over all of that, and there's enormous variation in that. I think in terms of normative policy, what we should do is very important to look for policies that can benefit, wherever possible, look for policies that can benefit the poor producers. That, I think, is important. A lot of what we've had has been partly luck, spillovers from improved varieties of rice, wheat and maize in the industrial countries have benefited producers in poor countries. But the success in products like cassava has been much more limited, partly because there's no reservoir of technological advances in cassava production or sweet potato production in the industrial countries. So really important to focus on commodities that are important to poor people, and that's probably something where we haven't done so well. My colleague Don Larson has a large project on a green revolution for Africa. He's just got some preliminary results now. And in, 6-12 months, you'll have lots more answers on specific issues for your question.
I actually have a follow-up to that. I forgot to ask you about public versus private research and development,
Right.
because this slide only covers public.
Right. Right.
A representative from the Gates Foundation was here a couple of weeks ago and talked about agricultural investment, and he said that he expects only a 50% success rate on, and that's not even the rate of return on it.
Right.
So hypothetically 50% of his projects will fail.
Yeah.
I don't know if, is that similar to the public sector or just agricultural research in general?
I'm not, I wouldn't like to quote a specific number, but this includes lots and lots of failures. It's just that there are some successes out there, that are really, really game-changing. And you think of the varieties of rice that came out of IRRI that dramatically expanded the production possibility for small and large producers. Those sorts of innovations have phenomenal rates of return that go on and on and on. Yeah.
Well, I think we have time for one more question. I think it's mine. So when you started off, you said that, well, obviously, if you go to this slide, that there's underinvestment in public R&D, and that the donor countries are not focusing enough on agriculture. So if we're going to fix that, are donor countries spending too much on something that we can redistribute, or is it that donor countries need to spend more on everything? And then after that, reception.
Well, I think given the problems of poverty in the world, it would be really, really desirable for donors to spend more on everything. I mean, I think there have been some really remarkable successes when you look at the extent of poverty reduction. The key thing hasn't been so much the actions of donors. It's been major policy reforms in countries like China and India, where there's been this dramatic reduction in poverty. Ideally, we'd see a lot more spending. I think the focus of the World Development Report 2008 was on the underspending in public goods in the rural sector. I think those documents very, very carefully just how much the rate of return would be from more investment in these public goods. Now, if you're looking for a place to find some of those resources, I think a lot of the resources spent in rich and poor countries on subsidies would be a good place to look. If you put $1 into agricultural research and investment and development, what you get is something like $10 back in terms of social benefits of that investment. If you put $1 into some sort of production subsidy that induces too much production in the wrong place, you've got a benefit of less than $1. So taking money from a lot of inefficient, distorting subsidies and trade policies would be a good place to start, especially when you see just how high these rates of return are. Unfortunately, it takes a long time to get a lot of these rates of return. The original investments in agricultural research and investment and development that yielded hybrid corn from the private sector and improved varieties of rice and wheat. There was substantial lags between them when that money was invested and when the benefits came in. Politicians often have a much shorter time frame, like now to the next election. Subsidies can generate smiles between now and the next election. But I think it's very, very important to think that the benefits are so much greater from improvements in the supply of the public goods. And governments focused on the things where the private sector can't do it could generate way, way, way more benefit.
Well, thank you. Can we thank you all?